Qualcomm stock just posted its largest single-day earnings reaction on record, a 15% move, against a historical average earnings day move of -3%. That inversion is not a sentiment story. It marks the moment the market decided the old valuation model no longer applies. For years, capital priced Qualcomm as a handset cyclical, a company whose fate tracked smartphone upgrade cycles and Chinese OEM demand. That framing produced a consensus analyst target of $168.50, even as the stock trades near $216. The gap between where analysts have the stock and where capital is actually placing it is not a timing lag, it is a category dispute. The repricing started in April, when Qualcomm announced an OpenAI partnership positioning Snapdragon as the primary platform for on-device AI inference in premium smartphones. Shares moved 39% that month alone, from $128.78 to $179.58. What that move told the market was not that smartphones got better. It told the market that the inference layer of the AI stack was migrating from cloud GPUs towards edge silicon, and Qualcomm owned the edge. But the April move was still interpretable as a smartphone story with an AI wrapper. The May earnings report removed that interpretation. CEO Cristiano Amon confirmed a custom AI silicon engagement with a leading hyperscaler is on track for initial shipments later this calendar year. That single line is what forced capital to reprice the stock category, not just the earnings beat. A handset chip vendor does not ship custom silicon to a hyperscaler data center. An AI infrastructure company does. The stock is now up 70%.
The repricing argument rests on three revenue streams converging at the same moment. And understanding why that convergence matters more than any single line item is what separates the current move from a sentiment spike. Automotive revenue hit $1.33 billion in Q2, up 38% year-over-year, a record. That matters not because automotive is large relative to handsets, but because it is structurally sticky. Connected vehicle design wins lock in multi-year revenue contracts, meaning automotive revenue does not reset with a consumer upgrade cycle. Capital that is trying to exit the handset cyclical thesis and find a new earnings floor has a specific reason to weight that $1.33 billion differently than it would weight the same dollar from a smartphone shipment. IoT grew 9% in the same quarter. As an exception to the handset decline narrative, IoT and automotive combined grew 20% year-over-year, which means the non-handset business is already large enough to partially absorb handset softness rather than merely offset it at the margin. The Snap AR deal for multi-year Snapdragon XR chip supply adds a third platform with a different demand driver. Extended reality silicon is not yet material to the revenue mix, but the market's willingness to pay for optionality explains part of why the PE expanded. Qualcomm trades at 22 times earnings. NVIDIA trades at 43 times. The current market structure tells capital that AI infrastructure names command a valuation premium roughly double what handset names carry. Every incremental dollar of revenue that recategorizes as AI infrastructure rather than handset cyclical compresses that PE discount mechanically. What this means is that the $20 billion buyback authorization operates differently in this context than it would have 6 months ago. When management returns capital at scale while simultaneously guiding toward a new category, they are signaling confidence in the revenue floor of the transition, which reduces the risk premium attached to the pivot. That is why the buyback announcement coinciding with the hyperscaler confirmation produced a compounding effect on positioning rather than just a mechanical EPS boost. But here is the part of this repricing that the data center enthusiasm is obscuring. Qualcomm CFO Akash Palkhiwala disposed of 5,000 shares across 7 separate transactions in March and April, while the stock was trading around $130. That is not insider knowledge of bad news. Executives sell for many reasons. But the pattern of 7 transactions, not one, at prices that now look dramatically below market, raises a specific question about what the CFO's internal view of the transition timeline was at the moment capital was pricing in the pivot. The hyperscaler shipments are on track for later this calendar year, but that means the revenue from that engagement has not yet appeared in a reported quarter.
The core tension in Qualcomm's repricing is that the stock has been recategorized on the basis of a revenue stream that has not yet generated a single reported dollar of data center revenue. Daiwa's upgrade to a $225 target, raising from $140, is the most aggressive analyst revision of the year on this stock. The analyst's argument is that Qualcomm rides the same ARM-based inference trends benefiting ARM holdings, meaning the upside case is not unique to Qualcomm, but is a category trade on the shift from GPU training to CPU-adjacent inference at scale. That framing is structurally valid. As AI workloads migrate toward inference, ARM-based architectures gain relevance.
Qualcomm's Snapdragon architecture is already optimized for low-power inference at the edge, and the hyperscaler engagement suggests at least one major cloud provider believes that architecture translates to the data center. The countersignal is that Qualcomm's Q3 guidance of $9.2 to $10 billion implies a sequential revenue decline from Q2's $10.6 billion. A stock priced at 22 times earnings on a category transition story absorbs sequential revenue declines differently than a stock priced for stable growth. If the Q3 report lands at the low end of guidance and handset weakness persists, the market will ask whether the AI infrastructure thesis is offsetting handset decline or simply coexisting alongside it without yet changing the slope. Reddit sentiment collapsing from readings of 80 to 82 in early May down to 22 to 35 within days signals that retail positioning has already begun rotating out. Retail exodus alone does not reprice a stock at this capitalization, but it does reduce the marginal buyer base that sustained the momentum phase of the move. The next incremental capital will need to be institutional, and institutional buyers at $215 need a concrete revenue timeline, not a roadmap. That timeline resolves on June 24, when management has explicitly committed to detailing the data center and physical AI roadmaps at the Investor Day. Eamon's Investor Day is not a routine update. It is the event management designated as the moment they would convert the category narrative into specific revenue architecture. The hyperscaler engagement that Eamon confirmed in May becomes the central test. If June 24 reveals a second hyperscaler customer or provides a revenue contribution timeline for the current engagement, the repricing at $215 gains a foundation. If the Investor Day delivers roadmap language without customer count or revenue timing, the stock's premium above the consensus target becomes purely a bet on management execution, with no near-term verification mechanism until shipments appear in Q4 or Q1 2027 results. The CFO's share sales near 130, the same level the stock occupied before the April pivot, now function as a benchmark in the other direction. If the data center thesis is validated at June 24, those sales at 130.12 will look like a significant misread of the company's own transition pace. If the thesis stalls, the CFO's exit near the prior range begins to look like informed positioning. June 24 is the event that resolves which interpretation capital assigns.
The competition risk in Qualcomm's data center push is not symmetrical with the upside, and understanding why that asymmetry matters for positioning is the final analytical layer this move requires. Qualcomm is entering a market where NVIDIA, AMD, Intel, and the hyperscaler's own internal custom silicon programs are already entrenched. The standard bearish reading is that Qualcomm is late and underpowered relative to these incumbents. That reading is correct about the competitive landscape, but wrong about the mechanism of capital movement. Hyperscalers are not trying to defeat NVIDIA with one vendor. They are trying to reduce dependence on NVIDIA by building a multi-supplier inference stack. That objective structurally benefits any credible alternative architecture, including Qualcomm's, regardless of whether Qualcomm ever matches NVIDIA on peak GPU performance. The relevant threshold is not whether Qualcomm wins data center market share broadly. It is whether the one confirmed hyperscaler engagement converts from initial shipments to a scaled procurement contract. Initial shipments are a test. A scaled contract is the repricing catalyst that closes the gap between $215 and the 43 times earnings AI infrastructure premium that NVIDIA commands. If that contract does not materialize within 3 to 4 quarters, the valuation reverts toward the handset cyclical baseline, which the consensus, still carrying hold ratings on 22 of its analyst recommendations, has never abandoned. The automotive floor changes this calculus in a specific way. Because the $1.33 billion in automotive revenue is contract-backed and growing, the company does not need the data center engagement to succeed immediately to avoid a fundamental earnings collapse. Automotive provides the runway for the data center thesis to develop without forcing a premature verdict. That structural buffer is what makes this transition attempt more credible than a pure speculative pivot. The downside scenario has a floor, and the floor is growing at 38% annually. The June 24 Investor Day, and specifically Cristiano Amon's ability to name customer count and revenue contribution timing for the hyperscaler engagement, is the event that determines whether the repricing at current levels holds or forces a mean reversion toward the consensus. The CFO shares were sold near $130. If Amon's June 24 roadmap converts the category argument into auditable revenue architecture, the CFO sold far too early. That is the benchmark the market will apply. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.